I would be delighted if there was a good reason for gold not to just blast off and head towards 3,000. Those good
Wow.
two reasons are a resilient U.S. stock market and high U.S. interest rates, which means a strong economy and everything, which to me would be a dream. That's why I look at gold right now as it's essentially it's a put option on the U.S. stock market. Silver is more correlated with the stock market if it goes down. That's why industrial metals are. That's why
Right.
this year is a bit of a divergence. I think to me, gold's looking ahead to what you just said is probably not getting better. That just the normal revisionary lower tendencies of elevated equities and elevated interest rates when you head towards a recession.
In a recent insightful discussion on the economic outlook in the precious metals market, particularly silver and gold, Mike McGlone, senior commodity strategist at Bloomberg Intelligence, shared his views on current and future trends. He expressed a keen interest in the factors influencing the price of gold, especially considering its potential to rise to $3,000. McGlone views gold as a form of insurance or a put option against a potential downturn in the stock market. The week began with gold showing a mildly positive tone, benefiting from a moderate pullback in the U.S. dollar and persistently low U.S. bond yields. The precious metal is currently seeking direction above the psychologically significant $2,000 level, with the U.S. dollar still influenced by expectations of Federal Reserve cuts in early 2024. On the upside, the precious metal should breach the $2,040 to $2,050 to convince bulls and extend toward the $2,065 area ahead of the all-time high at $2,150. J.P. Morgan has provided a forecast indicating that gold and silver are expected to outshine other metals in the sector. They attribute this to the Federal Reserve cutting cycle and a decline in U.S. real yields, predicting gold prices to reach an average of $2,175 per ounce by the fourth quarter of 2024. McGlone shares concerns about potential deflationary forces and hopes that the conversation won't involve severe deflation and gold nearing the $3,000 mark a year from now. Gold has witnessed record highs this year, primarily driven by geopolitical tensions and economic uncertainties. ING anticipates that the strength in gold prices will persist through 2024, supported by safe haven demand and the evolving outlook for U.S. interest rates. Before diving into Mike McGlone's insightful interview, subscribe to our channel and give this video a big thumbs up.
It'd be wonderful if this time next year we're not talking about severe deflationary forces and we're not
Yeah.
talking about gold heading towards 3,000. But I think those are just the trends that are your friends, and I don't see what stops them until you get to a long and lag to Federal Reserve easing. This is how the world's changed. Here's one thing that's a fact. Like as of today, we just printed the PPI year-over-year material goods number. It's down 0.9%. Now that's PPI. It's a 2 beta. It's a good. It's like just high. It's a 2 beta to CPI. And it's like very closely
Right.
correlated to commodities. And Fed funds upper bound is 5.5%. Yet they can't cut because most of their metrics are still very high. So I have to say that wide crocodile jaw disparity in some inflation metrics already deflating, commodities already deflating, and Fed funds still high, are just trickling down. The key trigger will be U.S. stock market just having a normal correction, and
Right.
that's why it's an inordinate burden for the stock market to stay up, which to me means that's your risk reward. Bullish gold, bearish everything else, and that includes silver and copper, industrial metals. I just published latest silver update. And the problem with silver is it's down 5 to 6% this year, along with industrial metals on average that are down about 20%, the Bloomberg Industrial Metals Index, and gold's up about 9 to 10%.
Right.
Those to me are bodies in motion that I think are at greater risk of accelerating next year, particularly, I should say more when the U.S. enters a recession. Obviously, it didn't happen this year. A lot of us were wrong in that, but the tilt is increasingly that way from a macroeconomic industrial demand standpoint. Europe's already in recession. It was just a few months ago they were hiking rates. GDP is negative, and retail sales are negative, and PMIs are negative.
Right.
China is very quickly tilting that way. Every time I type on the Bloomberg Terminal anything to do with China, property crisis I hear is there's hopium, but it's just getting started. just like Japan did. And a lot of people tell me it's a lot worse than the U.S. was when it peaked in 2005 and six. And then there's that U.S. bent. So to me, there's an inordinate need for the U.S. stock market to stay resilient in the face of recession, in the face of the normal effects from Fed hiking, which means that that's to me the biggest tilt for next year is these trends in commodities accelerate, and that favors gold versus everything else.
The Federal Reserve has shifted its stance by signaling a move towards reversing the most significant interest rate hikes in decades. Despite effectively managing inflation without triggering a recession or causing substantial employment losses, Chair Jerome Powell, during a recent announcement, conveyed the central bank's preparedness to resume rate increases if inflationary pressures resurface. However, the accompanying forecasts from Powell and fellow policymakers indicated a likelihood of rate cuts in the coming year. In echoing sentiments similar to those expressed by financial expert Mike, there is an emphasis on drawing insights from historical lessons. It stressed that the Federal Reserve should exercise caution when considering the addition of liquidity to the financial system. This cautious approach ensures confidence in avoiding a swift reversal prompted by inflation concerns. In recent market developments, the S&P index achieved a notable milestone by closing above 4,700 for the first time since January 2022. The index has demonstrated a substantial 23% increase, with an average annual return exceeding 10%. This positive performance indicates the stock market's resilience, aligning with the historical trends that Mike highlighted. The historical pattern suggests that the Federal Reserve tends to cut rates when the S&P 500 is down 20% on a 12-month basis, and raises rates when the index is up by the same percentage. Let's get back to the interview.
Virtually no need or incentive for the Fed to even consider cutting rates until we have some negative wealth effect to reverse the major inflation that massive liquidity provided with COVID. That to me is going to be the lessons of history. So when they go to make that decision to push that button to start adding liquidity to the system, they have to be quite certain they're not going to have to take that back right away because of inflation they helped create it. And to me, that's what's going to resonate. That's what's different from every single time they've eased in the past. So here's one little fact. Typically, when the S&P 500 is down 20% on a 12-month basis, since 1960, the Fed has cut rates.
Right.
When it's up 20% on a 12-month basis, they usually hike rates. It's up 20% on a 12-month basis. And their metrics for inflation, PCE, employment cost index, CPI core are all well above 2% targets. Yes, they're dropping, but they're closer to 4%. So I look at it as, why take the risk? Until the whites of the eyes and basically the stock market going down, there's no reason the Fed should ease. And yet the market's priced for right now, as we tape this before we get the news from the Fed, is as of the May 1st meeting, the market's fully priced for 125 basis point cut. And I think that's just silly.
Right.
The market, it's going to take a catalyst. And I think the catalyst for that to happen would be the U.S. stock market going down, because I look at it from a risk reward standpoint is, why bother? Everything's great. Why mess with it? So the latest report that printed in December for November is obviously quite strong, but it didn't change the base case from our Bloomberg economics team that we're clearly tilting towards recession. Now, we have many other metrics pointing that way. One is, I like to point out, we have recessionary declining demand in diesel, in unleaded gas, in natural gas, and container boards. And then we have things like the inverted yield curve, and just a simple fact, it was only a few months ago, most central banks were still hiking rates. Those effects, full effects, are not even close. So one thing they're watching real closely is retail sales, how retail sales will do this period. It was when retail sales came out in the end of 2007, that was one of those signals that the Fed should start cutting rates, and they had already start cutting rates. So by the time this airs, we might know, but
Right.
there's still all so much little data, minor data. The macro is, yes, I've been early, but if you look at the market, if you look at the indicators from the commodity markets, it's clearly recessionary. Gold's up, and the Bloomberg Energy Index is down about 20%. The Bloomberg Industrial Metals Index is down about 20%, and the Bloomberg Grains Indexes are down about 20%. So this is a clear global deflationary, recessionary trajectories. And the quick question I have to ask myself is, what are we doing to arrest those? And central banks I even start. Typically, you need a lag to the first Fed rate cut. Usually, it's about a year or two before things bottom. China is trying to stimulate, and the U.S. is just on the back end of massive fiscal stimulus that we cannot continue because we've ballooned the deficit so much.
How might the potential reversal of interest rate hikes by the Federal Reserve impact the economic outlook, particularly about inflation and employment? Considering the emphasis on historical trends in the discussion, how closely do you think policymakers align their decisions with past economic patterns, and what implications could this have for future monetary policy? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.